Don Vetker. And Don is going to talk to us about cash balance plans. Cash balance plans typically are going to occur. It's something that you would add to your plan, and Don is going to talk to us a little bit about what circumstances are in place when you should be thinking about a cash balance plan. So, Don, I'll turn the floor over to you.
Okay, thank you, Elke. Yeah, I guess I'm going to introduce kind of a new concept to you. It's called a cash balance pension plan. And we're seeing a tremendous amount of activity in this area, but it works for a certain situation. So what I wanted to do is kind of go through, explain it, give you an example of what we've done for some clients, and then see if there's of any interest to you. So the next slide, we were actually talking about limitations just briefly, just a minute ago. The new 2023 plan limitations, the salary deferral limit, the amount you can take out of your pay and put it into the plan, is increasing to $22,500. The catch up, which was $6,500 for this current year, is going to $7,500. And the individual contribution limit is increasing from $61,000 to $66,000. Now, what that is going back to the limits on profit sharing plans or 401k plans. No one individual can have more than that money going into their particular account. So even though the deduction is based on 25% of overall payroll, you might be able to shift a little bit to certain groups, and there is a dollar limit. But what I want to talk about today is the next one, DB, defined benefit, annual limit. This isn't a contribution. This is an annual pension benefit at retirement. So you could have a traditional pension plan that provides currently $245,000 a year to a person for the rest of their life. So it's not a contribution. Most people are very familiar with defined contribution plans. That's what a 401k is. The company defines what they're going to put in. Then once it's in there, it's up to you to invest it, and the investment gains or losses are yours. A defined benefit plan, and we haven't added any traditional defined benefit plans in years, but we're adding a tremendous amount of cash balance defined benefit plans. And basically what we do here is it's a traditional pension. We fund for these high benefits, or something less if you'd like less. And then we express it as an account balance. So it's a little bit different. You think if your mom or dad, or maybe even you have a traditional pension, you think of a monthly benefit. All we do in a cash balance plan is flip that so it looks like an account balance. So then there's the highly compensated that Kim talked about earlier. We need to know who's highly paid and who isn't, because we're allowed to discriminate against the highly paid. We can't favor them, but we can certainly not favor them. And then there's the annual compensation cap. No matter how much money a person makes in a year, we cannot count more than $305,000 this year, 22, or $330,000 next year. And for what it's worth, the taxable wage base that you're going to pay your retirement portion of your FICA taxes on is going to $160,000. The next slide, I like to just kind of talk about a little different approach for a client. And what I have here is, in a cash balance pension plan, there's a different relationship between the investment advisor, the actuary, that's what I am, and Definiti offers, and their tax advisor or CPA. They need to communicate together on an ongoing basis to make sure this plan is being funded properly and is on track for the purpose of the plan. So this is just something, it's a little different relationship. With a 401k plan, the investment advisor usually works with the employer direct always, and often the participants individually. In a cash balance plan, it's a pool. Everybody's money is in one plan. So the investment advisor works closely with not only the client, but the actuary and the tax advisor. So on the next slide, I try to say, well, who should be looking at this kind of plan and what's kind of happening out there? Well, what's happening out there is if you're very successful, your income is predictable. It's not a 1 year fluke. I had a great year and I'm not sure about next year. It's predictable. You're in a high tax bracket. And if you have employees, there's a favorable demographics. And what I mean by that is usually older employees and younger staff. That's the perfect situation to consider a cash balance pension plan. Thought I would take us through on the next slide on, well, what is the process here? The next slide, there we go. How does all this happen? Well, it starts with the employer. The employer is a candidate like the one I just mentioned. They're doing rather well. They're a little bit older. They want to save significant amounts for retirement. How do they go about doing it? Well, the first thing they do is they meet with one of our sales consultants and we gather information. It's mostly census. It's like, who are you paying? Who's your employees, their dates of birth, dates of hire, and compensations. And then we take that information and send it to our actuarial team. That's what I'm part of. And we analyze this information and give them an illustration of what we think they may like. Now, in the first section, they are also sharing what they want to do. And sometimes the sharing is, I want the owner to save as much as possible. That's okay. Then we know what to do. Other times it's, I want to provide a meaningful benefit for my people and I want to save as much as possible. So, it's a combination, but there's fact finding up front. Our actuarial team designs and works up the illustrations to be considered. They're presented back to the employer to make sure they're in agreement. They're often fine-tuned to best satisfy their objectives. And if everything is a go, we implement that plan. We average about one of these a day in terms of illustrations. So I was kind of going back over the last few months and saying, well, how many of these do you do? We do just about one a day. So, 300 or 400 a year is what we end up doing. Well, I'm going to give you on the next slide, kind of an interesting situation. I found this one terribly interesting. That's why I thought I would share it with you. So this is a situation that came in. And in this situation, the first thing we do when analyzing the people or the data, we identify the owners. In this case, we have two owners, happens to be wife and husband, and they share ownership in the company. Then you'll see several what I call non-highly compensated employees, people that didn't make over $135,000 last year. And lastly, we have two highly compensated employees that are considered highly paid. So this is the data they provided. Now, what they said is we would like to save between 500 and 600 more thousand per year. Is that possible? Our company's doing rather well. We're taking out a salary that is adequate for us, and we have extra money, and we'd like to push it to our retirement years. So that was the objective. Well, when I was thinking about this census, yes, they're financially successful. Yes, they're predictable income. Yeah, they're paying lots of taxes. I wasn't sure about the demographics, the employee group. This is kind of a large group for a cash balance plan, and you'll see various age differentials. We have an 84-year-old and a 63-year-old. I wondered how this was going to work out. So we got to work. On the next slide, you'll see what we came up with first time around. And I need to point out, Kim was talking to you about the different kind of safe harbors. They have the matching safe harbor. It happens to be dollar for dollar on the first 4% of pay saved. That's their current plan. So that's what we started with. Well, here's how we approach this. The first thing we do is we say, well, how much can the owners put aside using that monthly pension limitation as our guide? And we came up with a 57-year-old can do up to 240,000 per year. And then the 59-year-old spouse, 260,000 per year. So that was step one in our analysis. What can we do? Huge numbers. So we did that. Then the second step in our analysis is what must we do for the non-highly compensated employees? And you'll see a very modest amount, $1,200 for each of those individuals. So that's where we started with the cash balance plan. Now you might say, and I usually look at this and say, that sure seems discriminatory to me. However, there's a lot of math and tests that are behind the scenes, and I'll tell you how we solve that. So that's our cash balance plan component of the plan. Favors very heavily the owner employees. And you'll notice at the bottom, it doesn't favor the other highly compensated non-owners. They get nothing. I'm looking at the very bottom of that cash balance column. Then we move to the 401k salary deferrals. Because our owners are over age 50, they can both save $27,000 per year. And the rest of the employees are also saving pretty significant amounts in the plan. Next column, 401m match. We refer to internal revenue codes a lot, but that's your safe harbor match. That's 4% of pay for those that are saving. And you'll see we have two participants at zero and not electing to save under the plan, right about in the middle of the page. The last piece, profit sharing. This is what we have to use to make sure we can test everything positively and pass all the required testing to show this isn't discriminatory. And in this case, we're giving the owners 9.3% of pay, the non-highly paid 6.5% of pay, and the highly paid non-owners 3% of pay. I really did pick a complex situation, so I hope you don't mind about that. But this is complex, but on the next slide, what you'll see is a summary. You'll see, well, what is the situation here? The situation is the principals or owners, I'm in the first column, have considered earnings or compensation of $610,000, non-owners $1.1 million, overall payroll for the company $1.7 million. The cash balance plan, $500,000 credit to the owners. That's the 240 and the 260. $12,000 for the non-owners, very modest amount. 401k deferrals, that's just what they took out of their pay. Owners maximized, non-owners put in significant amounts, but not maximum. Then we have the match. Then we have the profit sharing. To maximize that profit sharing gives us the ability to favor the owners like we do in the cash balance account. Second from the last column, you see the employer cost. This employer is now spending $581,000 for themselves, $110,000 for their staff, for a total of $691,000, or 84.1%, the percent of the total of the contributions is earmarked or going into the accounts of the owners. That's something, isn't it? In any case, so that was our year one matching program. The next slide, we said, well, you should probably think about changing your matching safe harbor to the 3% non-discretionary safe harbor. And the reason we're suggesting that is because that now can be counted in our testing, whereas a match can't be counted. So now we're changing from the match to giving everybody 3% of pay, which really impacts that profit sharing component. We now can do less dollars for the staff and maintain the same benefits for the employer. So that's what you see here. So in this particular case, they liked what they saw in the matching plan. They also liked the idea of changing to the 3% safe harbor for the next year, 2023, and it cost them a little bit less. Looking at the summary on the next page, you'll see that now we've improved the 84% to the owners to 87.6. So it's all kind of a balancing act, passing all the required testing and making sure that we satisfy the objectives of the plan. I won't go through each of the items again, but basically what really has happened is we're using that 3% safe harbor to pass non-discrimination testing, which means they don't have to put in as much as a profit sharing. Okay, well, what's going on behind the scenes? So our next slide really talks about, well, what do we have to do to prove this is okay? First thing we have to do is satisfy minimum participation. We have to give enough people in the cash balance plan a meaningful benefit. So that's step one of designing a plan. Step two is we have to make sure that the average benefits provided to the non-highly paid are at least 70% of the average benefits provided to highly paid. Now, when you saw me go through all those numbers, it still felt kind of discriminatory, I guess you'd say. But what's happening behind this is we're putting more in the defined contribution plan for younger people. Those monies will grow over a longer period of time, which is why we can favor the older people, or in this case, the owners in the plan. So it's a combination of a lot of different testing going on all at once. If you're going to do a plan like this, you have to have a minimum allocation gateway. In other words, you have to give at least 5% of pay to all your staff, but it could be even higher. In my example, it was higher. It was up to 7% of pay. So there are minimum requirements. There's making sure there's testing by different rate groups, making sure the maximum benefits aren't violated, or tax deductions aren't violated. And lastly, as Kim mentioned earlier, top-heavy determination. When a plan is top-heavy, that just means, as she mentioned, more than 60% of the money goes to the owner employees. Then it's top-heavy and you have to provide minimum benefits. And we do that in all of our studies. Now, this changes each year. You have to satisfy this each year. So one of the things that we want to be careful of or pay close attention to, I've listed on the next slide, is you have to pay attention to changes in your employee demographics. Let's say a lot of your young people left you and you hired a lot of 60-year-olds to replace them. All of a sudden, the whole demographics is different, and it makes it very difficult to pass these tests like I could with this particular employee group. So you have to pay attention to that. You have to pay attention to investment performance. Now, unlike the 401k, this plan provides a fixed contribution with a fixed rate of return. And it's up to the employer to make sure that that fund has enough money in it to pay those benefits. So the investment risk is on the employer in these types of plans versus employee in a traditional defined contribution plan or a 401k plan. So we watch that and we pay attention to those and we guide the employer. The investment has been a little bit less this last year, could be this year, could be a lot less. And how do you make up that difference? You amortize it into the future. And we also give a recommended, and then there's a maximum deductible. So there's quite a bit of contribution flexibility in these types of plans, at least after the first year. Now, maybe things change for the employer. This might be too much for them in the future. They can always amend it and reduce contributions or increase them if contribution limits increase, but it can be controlled. The only thing they can't do is they can't take away an account balance already earned to date under that plan. But you can modify it as time goes on. And we want to pay very close attention to the funded status of the plan, especially as we approach the end of the life of the plan. So this plan is accumulating. There's an account balance. It's growing with a fixed rate of interest. And we want to make sure that trust fund has the right amount of money into it. And the closer you get to retirement, the more careful you want to be. You don't want to have a 2022 year when the market is down 20 or 25% in your last year of your plan. You instead you want to set aside or become a little more conservative in the investments, so that you don't have that volatility at the end. Now there's solutions for it. You just keep it going a few more years till it catches up, so all of that can be handled. What do we do for you? On the next slide, we prepare annual valuations. That just shows you the minimum required, recommended, and maximum deductible contributions. It's a range. It's not a fixed number. It's a range. We do the testing and participant statements of account balances. On the next slide, we also do the annual reporting and participant notices. You have to file 5,500 for these plans and an extra Schedule SB that talks about the funded status of the plan. If the plan is covered by the Pension Benefit Guarantee Corporation, that's a new concept, but that's the governmental entity that charges you a premium and guarantees benefits if you should go bankrupt with an underfunded plan. Most cash balance plans aren't subject to PBGC, because you'll notice on the next slide where PBGC says all plans are covered except owner-employee plans. So if it's just a husband and wife and that's all that's in the plan, no PBGC. If you're a professional service corporation with fewer than 25 participants, like a doctor's office, law firm, CPA, etc., you're not covered. But if there's a question, we always want to make sure we know whether you're covered by PBGC or not, because it does make a difference in some of the testing that we do. Lastly, well, what about plan termination? So these plans have a life of their own, and maybe they stop actually, or I use the word terminate, when the business is sold. That's usually one situation. Maybe the business experiences a downturn and they can't afford the plan. We can terminate it and distribute the account balances to date. Or lastly, maybe it's just plain run its course. It did what it was supposed to do. The owner retired, and we terminate and distribute the assets. And I'll go through on how a plan is terminated on the next page. It's really just a decision to do that. So you decide to do it. You have to give participant notices. You have to provide election packages to the employees. And here's one thing a little different than what you might see in the 401k world is there's their account balance. You're going to say, you want this? And they could say, yes, I'll roll it over. Or they could say, I'd rather have that in monthly installments. Now, hardly anybody ever does that, but that has to be an option in a cash balance plan. And if you're terminating a plan, you have to let PBGC know. And these do take several months to wind down, just because there's timing requirements for each of the notices. Well, we talked a lot. I kind of rushed through it, I think, but I wanted to get your mind thinking about if you're in that situation and you want to do something very significant, usually for the owners, then this is the type of plan that you would adopt, and you can set aside significant amounts for retirement. Did any questions come in, Elke?
Well, Don, I love it when you present and talk about cash balance plans. Obviously, there's a lot to consider. And so I think it just really demonstrates the breadth of knowledge that we have here at Definiti. So if a cash balance plan is something that you're thinking about, we certainly want to make sure that you know that a resource is available. So yeah, Don, there are a few questions. So let's just kind of jump into those. Can you talk a little bit about how, let's see, this question is, how are the employees required to make contributions to a cash plan? And you kind of covered that, but let's just reiterate that. Are they required to make a contribution?
They are not and cannot. This is an employer-funded program. Yes,
very different than
very different than the 401k.
Right, it's not a contribution, it's a benefit.
Yeah.
And then when can employees take their money out of a cash balance plan?
Typically, they take it out. The plan has a normal retirement age and possibly an early retirement age. Typically, you'd see age 65 or maybe age 62 in terms of retirement. Or if they terminate employment, they can take their money out at that time.
Mhm.
So it'd
Yeah.
be assuming they're vested. I didn't talk about vesting, but you are vested after 3 years. You're in this plan for 3 years, then you're considered vested, and you would be entitled to roll your money over to a new employer's 401k or an IRA.
Yes, that was actually the next question. Someone
Oh,
had asked, a vesting schedule be applied to the funds. So yeah, that's perfect. Thanks for
it
covering that.
can, but it's a little faster than normal vesting schedules because cash balance plans have to have a 3-year or faster vesting.
Mhm, mhm. Good. Good. Okay, so I think those are the questions that we had that were entered. If any others come up, then we'll be sure to pass them on. I would like, let's look at the next slide because I do want to talk about some of the additional resources that we make available as Definiti. And that would be obviously this session. Don's done a great job in explaining what a cash balance plan is and when that makes sense for you. So the session is available as a replay. And then we have a couple of additional resources. One of them is an Insights article talking specifically about cash balance plan, listing the differences, how it's a little bit different than a traditional defined benefit plan, and then a couple of case studies as well, so that you can kind of see how a cash balance plan might impact it. But obviously, if you're interested in this kind of plan, reach out to your RPC, and they in turn will reach out to our actuarial consultants who will help you with an illustration and see if it's right for you. Lots of things to consider when you're thinking about a cash balance plan, and you've illustrated that for us today, Dawn. Thank you so much.
You're welcome, and thank you everybody for joining.
Yeah, thank you.